Hey everybody, welcome to Charts and Coffee. Great to see everyone. All right, so I have a couple notes here to kick off the session. And this is what we're going to be dealing with. Well, already we have the Bank of England rate hike, unanimous rate hike. So we're seeing other central banks getting hawkish on their monetary policy, not just the US. ISM services number coming up at 10. We've already seen the data at 8:30, and you can see the market did not like that. So let's take a look at that Thursday. There we go. February 3 hot zones, 8:30 a.m. We had the press conference. Look, when other major central banks like the European Central Bank are making comments about the way that they're viewing the economy, that does have reverberations. And I would not underestimate some of that also being in play with these unemployment claims numbers. Now, remember, of the pillars of macroeconomics, jobs are one of them. So we want to continually check back on here we go. Want to continually check back on what expectations are for May. Does that column continue for the 50 to 75 target rate? Does that continue to climb, preferably to and through 80? And then does June continue to climb for a third sequential meeting rate hike? And then do we get any clarity past June? Do we start to see a dominant column in July? This is the way to understand what the Federal Reserve is going to do. In fact, this futures contract, that is what it does. That's its sole job. That is what it does. So if you've never checked that out before, what I would highly recommend doing is check out CME, and you can search the, here we go, FedWatch tool, CME FedWatch tool. And that will get you to this particular site. And, you can shut out all the noise. You can shut out all the speculation and just look at the rate of change of what we are expecting, what is mostly being discounted from the Federal Reserve. All right. So as always, these sessions are about, hang on one sec. Don't want to lose y'all. As always, these sessions are about your questions. And let's jump on into our charts. Let's get into it. All right. First of all, first question that we have is Azendi. All right. So can I talk a bit about the hourly price movement ranges? Is that part of my submarket sonar class? So sure. So for those of you that don't, and maybe you've heard me talk about HPMRs, hourly price movement ranges. What that is a process that I created. It started with my last book, and I always forget whenever the heck that came out. 2007, 8, gosh, 11? I don't remember. It's been a minute. And I started diving deeper into historical volatility, both on the session basis, day to day, and hourly. And once you realize you have this data, this historical volatility that tells you what the expected price movement range is hour to hour, then it gives us some latitude to start plotting support and resistance zones that are sensitive to time and volatility, not price swings, not price-based patterns, not even volume, volatility and time. And so that's what they measure, right? That's what they measure. They've never been part of a class. I've given the futures version of the HPMRs to the futures room indices for years, and I have a slightly larger complement of the hourly price movement range symbols in the Sector Secrets Mastery. And then when I have done some day trading, these have to be updated about every 2 to 4 weeks, depending upon contraction or expansion of volatility. So with that being said, they do need to be updated. It's not as if you have one set, it's going to take you, throughout the rest of your time trading that symbol. They do need to be updated. So we've done different versions of, whatever the current HPMRs would be for a class. But no, the submarket sonar class was about volume, and that's what included the V-score, anchored VWAP, and anchored V profile. So thanks for the question. All right, next up, UNH, right? So what's going on with healthcare? What's going on with some of the heavier weighted names within healthcare, which is what you can see here. And what we have here is still a lot of chop, but it's chop that had a preceding uptrend. So the directional bias is, mostly up, right? Even though it's neutral right now in terms of trend and momentum, I would expect the market to continue higher. Then within the context of chop, right, we want to think about what tools would be ideally suited to measure that chop. So I like to start with the Darvis. Let's find where the price levels are here. And then finally, you even mark this one down in here. So that's where the support area is. And then when price is sinking into that support area, then you want to consult something like the Ready Aim Fire, which is a premium tool here at Simpler Trading, or a free slow stochastic. And that slow stochastic is something that you can set up right on Thinkorswim, TradingView, TradeStation. It's a built-in indicator. What I would tell you to do, though, use my settings. And the settings are designed to be slower. In other words, we're having more discerning signals. So that's why I recommend the 21.3. These settings have worked very well for a very long period of time. I'm not a fan of a shorter slow stochastic. And I'm not a fan of a narrower overbought and oversold range. Although if you know what you're doing and you do want to have a quicker signal into overbought or oversold territory, of course, 70-30 or even 75-25 or other sort of distant second and third popular default settings, but none more popular, nor do I believe more effective than an 80-20. So UNH, it's coming off that oversold level. Typically, we're going to stall somewhere around the halfway mark of the range. And then with that being said, the idea is likely to close that gap. I'd say we could close that gap and likely then find some resistance. It's a choppy market. Be very cautious engaging chop in the middle of chop, right? The chop within the chop. Be really careful with that. What are my thoughts on IWM? So we'll start with RTY to cover that, because if there is a futures contract that is representative of what's happening in the ETF, SPY, ES futures, NQ, triple Q futures, in this case, IWM, RTY futures, I'm going to start there. This is a downtrend, gang. Let me get my drawing tools here. What is a session of charts and coffee without the drawing tools? All right, so here we have the drawing tools. And what we need to remember about this is bearish momentum, bearish trend. That's bearish structure. We're looking for a visit to the 21 propulsion, getting down into the wave, or I should say getting up into the wave. This is short the rip, gang. This is a short the rip situation. This is not about a stochastic. This is not about chop. There are a number of double red downtrends in this environment. This is one of them. All right. So short the rip. All right. Next up, can we take a look at NVIDIA? Sure. All right. Taking a look at NVIDIA. Another double red, another short the rip. Elliott, the only thing that I'll say about NVIDIA and this is an important one, take a look at this pattern and mostly the break through that level being north of the 200 propulsion, even though we're double red. Double red and below the 200 is a very different amount of certainty for bearishness than double red and above the 200. All right, and when I say 200, exponential moving average. All right. So I would say this is what you want to focus on for a potential short. Is to be short the rip. And it's going to be even better if you're looking to short the rip um, with confirmation of that reversal or that stall pattern. Okay. So that's what I would focus on there. All right. Moving on. Thank you for the question. AMD. Okay. So moving on to AMD. Now, anytime we have, as you can see here, earnings or post-earning environment, we've got to let the market settle down for a moment. We've got to let the market settle down. So you might say, Rog, what's going on here? Is this still an uptrend? Or sorry, is this still a downtrend? Or north of that 200 exponential? What's the story here? And what I would say is ultimately we have to wait for some sort of pause pattern. We have to wait for some sort of pause pattern, which might be the minor high or an inside candle. And then we could look for continuation to the downside. So that's the idea there. That's what I would focus on there. So give it a day. That could be today, right? Give it a day. And I want to see one of two things, preferably an inside candle inside the wave, also known as a harami, or a minor high, All right. Okay, moving on. UNG. I'll tell you what, UNG has been a tricky one. I hate missing significant moves, but I've been warning everybody that, look, what a great move. And if someone's a momentum trader, gosh, what a nice move from, what I would say is an oversold support zone, right? And then you have your storm, quite literally your storm surge in terms of natty gas being very storm sensitive. Once the seasonal that exists between, say, August and November plays out, everything else becomes, what's the weather? What are we expecting? And this, I fear, really will have hurt a lot of traders, because there was no doubt, and this is the way the market tends to move. It moves in the direction of the most stops. This is not stop hunting and all that kind of insidious, the market's out to get you thing. It really isn't. Truly, okay? This was a high. Obviously, there's your Darvis. Breaking this high, what I ultimately believe we saw were a lot of stops run, and momentum begets momentum. That's just the way the markets tend to go. We moved from oversold to overbought. All right. We moved from oversold to overbought, and we've just come right back down to that level. So, to think that the market's going to keep going, my question is going to be, well, based on what? Why and what? We already had a great why with the move to the upper end on the storm. But what's going to keep it moving after that? Another storm? A supply disruption? Those are things that would be then a secondary narrative that the market could grab onto and justify buying this market as it moves higher. I don't believe it's a trend. Forget what I believe. Look at our tools, right? It's not a trend. Got a lot of bullish momentum, but it's not a trend. So this is where I think there's going to be a battle being fought. We got to be really careful with that one. All right. I completely agree. Battlehawk, it's exactly. If we have a yellow trend, and take a look, absolutely. Right in there. It is overbought. It had a great candle, which again, I fear got a lot of folks long, especially near some of those highs, which just kills me because that's such a dangerous way to trade in the context of chop. So is it shortable? Look, I don't want anything to do with this thing. If this is the kind of action that I'm seeing, I think there's so many other places that we can focus on for clarity. I do not love this. I do not love this. All right, moving on. Hey there, Kim. I want to thank you once again for your teaching your scale in, scale out. Right. I got to we call it scalability. I got to give you all credit for opening your minds to just a different way of managing your trades. Scaling in, scaling out. I was talking about this yesterday in the chat room in the mastery, winding down. We did a closing session, and I said, look, I know it's a kind of squiggly line between what it means to add to a position and scaling in and scaling out. It might seem like the same thing, but it's really not. Most of the time when traders add to a position, they're not adding at levels that were predetermined at the time of the original trade plan. In other words, if at the original moment of your trade plan, you've got 3-4 levels, and then you are going to tactically use your budget for the trade to enter and enter again and enter again, to me, that's scaling in. Scaling in demands that you know what those levels are even before the very first entry. Adding then becomes this sort of random dollar cost averaging, cost basis reducing reaction to a certain level not holding and unrealized losses. And I know that's not the way it is for everybody. I know that's not the way it is for everybody. It's the main idea behind being able to scale in and scale out is starting at the very beginning. What's my budget? What's my risk? And then what can I buy within the zone and remain within my budget? And I know those are very different thoughts and sort of processes that we're typically taught. But, Kim, to your point, I think a lot of times position management, trade management, position sizing is often overlooked for a new secret squiggle or what's the entry, when in reality, what keeps us in the game is proper position sizing and risk management, right? It's the unsexy part of trading. All right. Good morning, Jody. Thoughts on why some stocks were pulled relatively lower than others after Facebook earnings? Oh, gosh, Jody, terrific question in that. Look, Facebook is part of XLC. Facebook is part of QQQ. Facebook is part of the NASDAQ. So this is where, if you're familiar with the boats and tide, boat is the stock, tide is the sector, and even the index. So where is that tide most affected? So you want to know, what boats are sharing that ingoing, or in this case, outgoing tide with Facebook. And so when we have an environment like we do now, and this has been increasingly influential since 2008, we have an environment like we have right now, we have to remember that ultimately high concentration weighting, and Facebook is a high concentration weighted stock, and the S&P, NASDAQ, and the Dow are high concentration weighted indices. We have to remember that never before have stocks been more connected than they are in this passive investing universe. So as far as why one market might move more than another, again, remember the amount of, and so it's a secondary thought, right? The amount of the move, right, should be considered a percentage of the value, right? 100 point move in Amazon's nothing, right? 100 point move in Facebook would be losing a third of its value. And so this is where not only do we have to remember, and I'm going to show you something here, not only do we need to remember the moves relative to their value, we have to also remember moves relative to their historical volatility, right? So, 100 point move for Amazon, like I said, not that crazy, not that crazy at all. That'd be a little bit higher, but let's say an 80 to 90 point move in Amazon is not out of the question for just sort of a daily expectation, session to session. But if I were to look at the same data for Facebook, and I think most of you all know this, it's just probably never been quantified like this before. We're talking 10 points, right? So those are, I believe, think about the passive investing weighting, and then think about the historical volatility. All right, so I hope that makes sense. Deer, sure. All right, so when it comes to deer, we have a neutral trend, bullish momentum. This one's in chop. So what I would say is cut the range in half, Darvis to Darvis. Look at the halfway mark, all right? And look at the way price action is reacting right in here. That could be, and you can see it has been, that could be an aggressive buy level, okay? That could be an aggressive buy level. All right, so as always, gang, that 20 minutes does fly by. Thank you again for spending time in your day. Thanks for being a part of the Caffeinate and Dominate crew. And I'll see you tomorrow, same time, same station. Be good to each other, gang.